Welcome to Collin Investing, your go-to source for actionable finance and investment insights. Today, we're tackling some major market shifts, the new U.S. auto tariffs and their global ripple effects, escalating trade tensions, the buzzing AI investment scene, and a close look at key stocks plus the overall market direction. Let's dive in. All right, kicking things off with a quick economic pulse check. Last week, U.S. initial jobless claims came in at 224,000. Broadly speaking, this points to a labor market that's remaining quite stable. However, pay attention to this detail. Continuing claims specifically in Washington, D.C. have climbed to their highest since 2021. It's a nuance worth noting as we dive into the bigger policy changes happening right now, starting with tariffs. Now, shifting from those labor numbers to the policy causing major waves. An executive order just dropped, imposing a significant 25% tariff on all imported cars. Mark your calendars. This kicks in the 2nd of April. Unsurprisingly, the market reacted quickly, with most auto stocks declining following the announcement. This is where things start getting really interesting for the auto sector. And interesting is an understatement when you see the potential fallout for foreign brands. Look at South Korea. Hyundai and Kia brought over 1 million cars into the US last year. This 25% tariff could wipe out nearly 40% of their operating profit. For Japan, it strikes at an economic lifeline. The US market accounts for almost half their total auto sales. We're talking about profits potentially being cut in half for giants like Toyota and Honda, and even steeper drops projected for Nissan and Mazda, possibly up to 66% and 34%. These numbers are staggering. Now, while those foreign brands face a direct hit, you might think Tesla's in the clear with its US manufacturing. Initially, yes, analysis pointed that way. But even Elon Musk admits he hears a non-negligible impact from imported parts. Beyond that, look at the global picture. Around 37% of sales are in China. Growth is slowing, the product line isn't fresh, and Europe's sales plummeted nearly 50% recently. Add Canada freezing subsidies. Suddenly, Tesla's unique position looks quite challenging. But the story doesn't end with individual brands like Tesla. We need to look deeper into the veins of the auto industry, the supply chain. Crucially, these aren't just tariffs on finished cars. They hit auto parts too. Imagine a component traveling from the US to Mexico, then Canada, and back again before it even reaches the final assembly line. Each step could add cost. This complexity means the final price impact is likely to cascade, potentially pushing well beyond that initial 25% figure, with cost potentially spiraling throughout that tangled supply chain. Who actually comes out ahead? The blunt answer: likely nobody. And the group taking the biggest hit: consumer. Expect fewer choices when you are shopping for a new vehicle, and brace for significantly higher prices. Okay, we've established consumers likely pay the price. So why impose these tariffs? The argument goes much deeper than just saving auto jobs. It's about the fuse EVs enabling autonomy and protecting the entire US industrial base. Think about it. The auto sector supports over 70% of special metals for aerospace, and is crucial for military-grade chips. Without a strong domestic auto industry, those chip costs could surge 300%. So this is framed as a crucial move for industrial and even national security. So while the US frames this tariff move as protecting its industrial base, the international reaction is predictably tense and varied. We're hearing strong condemnations from partners like Canada and the EU, calling it a direct attack and a double blow. In contrast, key Asian players like Japan and Korea are adopting a more cautious stance, keeping all options on the table. Interestingly, Vietnam is reportedly already lowering its own tariffs, perhaps trying to smooth the waters proactively. This divergence really sets the stage for what comes next. So, beyond the tough talk, what actual moves are on the table? The EU is prepping retaliatory tariffs, targeting specific US goods, while Canada is bolstering its own auto sector with significant investment. Frustration is palpable in Asia, especially after recent US investment promises. But it's not all conflict. We're seeing hints of negotiation, like potential adjustments for Canada based on US parts. Still, the Zomalate remains Trump's threat of even bigger tariffs if allies unite against the US. Speaking of global tensions, the direct US-Ukraine front just saw significant escalation. Washington added over 70 Chinese entities to its export blacklist, focusing on firms involved in advanced AI chips and supercomputing, citing national security. But here is a twist. Trump has linked potential tariff reductions to the sale of TikTok's US operations, essentially turning it into a high-stakes bargaining chip. This signals increased friction, yet keeps the door open for negotiation, even as the spotlight sharpens on the AI sector itself. That focus on AI brings us right to the debate. Are we in an investment bubble? Alabal Chairman Tsai raised concerns, and headlines about Microsoft pausing some new data center builds added fuel. Microsoft calls it optimization, shifting focus internally, and note that Google and Meta reportedly grabbed that capacity quickly. So, bubble, or just temporary adjustment, with valuations like Nvidia's forward P/E still around 25. It's not looking like a full-blown bubble yet. Definitely something to monitor closely. Now, shifting from broad tech themes to specific company performance, let's examine Lululemon. While their latest earnings actually topped expectations, that wasn't the main story. The real focus was on their guidance, which frankly disappointed across the board for Q1 and the full year, pointing towards notably slower growth, especially in North America. Hello everyone, and welcome back to Collin Investing. Alack. Announcement? It signals potential headwinds for the brand's momentum. While Lululemon faced headwinds from its own guidance, AppLovin's recent trouble came from an external attack. The stock cratered roughly 20% following a short report from Muddy Waters. They're essentially questioning AppLovin's key performance metrics and data collection methods. Interestingly, this sharp decline pushed the valuation back towards what could be seen as a more reasonable range for 2025. However, the technical risk is significant now. Watch that $230 support level closely, as a break below could trigger much further downside. Now turning to the chip giants, NVDA's chart is flashing a warning. A monthly close below $111 looks technically ugly and could leave buyers from the last 9 months underwater. Minor support sits around 102 to 106, but the real test is below 97. It wasn't a great day for AMD either. Jefferies downgraded the stock, pointing to weaker AI momentum and rising competition from Intel, sending shares down. Beyond the chip space, there has been chatter around Google. You might have heard rumors about Android going closed source. Let's clarify. They're not shutting the door completely, but rather changing how updates are released internally first. Interestingly, some analysts think this could actually nudge developers towards Apple. On the chart, keep a close eye on the $163 level for Google. If that support breaks, especially with the market looking shaky, a move down towards the 147 area becomes a real possibility. That market uncertainty we touched on, it's creating a real split between the big banks. You have US giants like JP Morgan calling this pullback a buying opportunity, but across the Atlantic, European banks like UBS and HSBC are turning cautious, downgrading US stocks, specifically due to these tariff fears. It really boils down to one critical question. Are these tariffs just a short-term shock, or are they signaling a longer-term economic drag? Given that clear divide in outlook, tariffs are undeniably the main theme steering the market. So, buckle up for continued volatility, possibly more consolidation. But let's keep the long view. Market downturns don't diminish the quality of fundamentally strong companies. In fact, these pullbacks often create chances to buy solid stocks at better prices. We're even seeing hedge funds wading back into cyclical sectors like banks and energy, hinting they see value emerging. And that wraps up our deep dive into the current market turbulence driven by tariffs and shifting strategies. We hope this analysis helps you navigate the uncertainty. If you found value today, please hit that thumbs up and subscribe to Collin Investing for more actionable insights. What are your thoughts on these developments? Let us know in the comments. Remember, all trading involves risk, so always do your own research.